Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight Special Webinar for Q1 2019. My name is Nick Basso, and I'm a Portfolio Administrator in Ironwood's Asset Management Division. Tonight, it's my pleasure to introduce our featured presenter, the Chief Investment Officer for Ironwood Wealth Management, Mr. Sean Rogers. Sean is a charter holder of the financial analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those into the chat box on the GoToWebinar panel on your screen. And at the end of the presentation, we'll compile the questions, and we'll definitely do our best to address all of those. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, please take it away.
Thanks, Nick. Thank you, everyone, for joining us this afternoon on our call today. As everyone probably is aware, the fourth quarter of 2018 brought with it a tremendous amount of volatility. So we decided that we wanted to make sure we were available for everyone and got some of this information out a little bit early with the special webinar. During periods of high volatility, it's very important to remember that we build long-term plans. We do not invest in aggressive asset classes for the short run. We invest in them for long periods of time. And because of this, we can potentially earn higher returns. However, we do have to expose ourselves to periods of time like the fourth quarter of 2018. Unfortunately, there's no way around it. In order to potentially get higher returns, that's what comes with the territory. However, it's good to know that the advisors at Ironwood understand this, and we build each client's portfolio with prudence. During this heightened period of volatility, it's nice to know that some safe assets actually held up. In the fourth quarter, a big chunk of our safe assets actually were positive and did exactly what they're designed to do. If anyone should have specific questions about their portfolio, we ask you to please reach out to your primary advisor. We will get to everyone's specific questions in a timely manner. Tonight, or this afternoon, I ask that you ask questions that are more general in nature, more economic focused. Today's webinar is going to be a little bit different. I focused less on what exactly the exact figures, and I want to get through the webinar pretty quick. I've pared it down to about 25 slides to try and get to as many questions as possible. So I want to leave, a good chunk, 20 or 30 minutes for questions. So please, if you have any questions, whether you have questions right now and you want to jot them into the box, if I hit on them, we'll kind of skip over them. But if I don't hit on them, then I will definitely get to as many of the questions as I can at the end. So with that said, let's go ahead and jump in. The fourth quarter was not pretty. The S&P 500 was down 14%, of which 9.2% of that came in December. It was the worst December since 1931. The NASDAQ was down 17%. Emerging markets, although in October they were down somewhere around 13-14%, they actually had positive November and December to only finish out the quarter down 7.5%. So although we're still down 7.5%, it was a little bit of a bright spot. Developed International also had a very bad October, but not as bad November and December. So Developed International was only down 12.5%. One of the big downward pieces in our portfolios specifically, because we have a little bit of an overweight, is small cap domestic, which was down 19% for the quarter. Like I said at the beginning, there were some spots in the portfolio that did okay. Global bonds were up 1.4% for the quarter. So in a period of time where you see equities do what they did, it's nice to see that bonds held up. That doesn't always happen, but it did happen this time, and safe pieces of our portfolio definitely held up much better than the aggressive portions of our portfolios. We actually had highs in the domestic markets right around October 3rd. The S&P 500 high was right around 2940 intraday, 2930 close, 2931 close. On October 3rd, Jay Powell announced that we were a long way away from neutral, implying more rate hikes to come. 10-year treasuries spiked from about 3% to 3.25% in a span of 2 or 3 days. That's 25 basis points. That is a very large move for interest rates in a very quick period of time. Stock market started to price in a recession due to the Fed tightening too quickly. The yield curve flattened dramatically, which also worried investors about a pending recession. We'll get to why here in a minute. Right around that same time, global growth started to slow, albeit still growing. We think a lot of that had to do with trade and tariffs. The yield curve. Why is it so important? And why is everyone so concerned on whether it inverts or not? Well, the reason that there's a lot of economists that look at the yield curve and want to know if it's inverted or not is because the last 9 times it's inverted, 7 of them have led to a recession. However, those 7 times, as you can see here, the average time in months of a recession after the yield curve inverted was 14 months. So although it has been very accurate, meaning when it happens, it does lead to a recession, it's not an imminent recession for the most part. The fastest time was in 1973 when it was 7 months, and the longest time was in 1968 when it almost took 2 years for us to actually see a recession after the yield curve inverted. This time is a little different. The Fed, there's a few distortions. The Fed, the balance sheet, and the ending of QE. So we've got $600 trillion in QE that's being sopped up every year from this point forward. And also the other thing that's kind of unique to this period of time is yes, we've had an expansion that's 10 years old. And in July of this year, if it continues, it'll be the longest expansion we've had. We don't see a lot of inflation expectations with this expansion. Normally, we have the economy running a little bit hotter, and we'd be in the midst of some inflation expectations when we see exactly opposite of that right now. We'll get into that a little bit later here too. When Jay Powell and the Fed came together in December, they actually were a lot more dovish than they were on October 3rd. And they had some comments that were dovish with the December rate hike. They were priced, the market was priced in a rate hike in December. Basically, everybody knew they were going to hike, although they probably could have made an argument not to hike. It basically was priced in, and if they wouldn't have hiked, they would have probably scared the market more than if they would have hiked. So they hiked and they came out with a bunch of dovish comments, which has caused the Fed funds futures basically to give a probability of 91% probability that in 2019 we'll end up at the same level of Fed funds that we currently are at, or possibly even lower, meaning we'll either have no hikes in 2019 or we'll have actually a cut in 2019. So there's a 91% probability priced in by the Fed funds futures currently that we have no rate hike or a rate cut, which is much different than what we were looking at in October. And the 10-year Treasury has responded because of this. So the big question here is, are we or are we not going to see a recession? The market has priced in a high percentage probability of a recession. So one of the things that I like to look at is, okay, what's sentiment out there? You can see if we look at searches for bear market by Google, you can see that it's at an all-time high. If we look at Google searches for recession, it's not at an all-time high, but it's definitely getting up there to where we were in the financial crisis. So what that tells us is that there's probably a lot of folks who, if they wanted to sell, they have sold. And just to give you a little bit of a recent example of this is if we were to look at Bitcoin and Ethereum Google searches at the end of 2017, you could see a spike of Google searches, and that's right around the time when Bitcoin went to almost 20,000. So there were a lot of buyers, and they were already in the market. This was showing that, hey, they're already in the market, so there's probably going to be a reversal. It's a contrarian indicator. And so that's kind of what we see with bear market searches and recession searches. So is a recession looming? That's the big question. And that's if a recession's looming, then the market may have a little bit of more downside, but at these levels, we don't see a bunch of downside if we do have a recession. If we don't have a recession, we see significant upward movement in stocks. So we think the risk is actually to the upside if we avoid recession, which is our base case. So we don't think a recession is coming. Global growth, yes, it has slowed a bit, but not to the levels that we would be concerned with a recession. The wealth effect is real. In the fourth quarter, the stock markets took away $2.4 trillion of net worth. There is a confidence effect. It's a self-fulfilling prophecy. It's when consumers start to look at their accounts and they start to not spend money because of the wealth effect, and it reduces confidence. There's also business confidence. The trade uncertainty with China does not help with this. And so there is a risk of recession, and it has increased, and the market has priced that in. But we believe that at nearly 20% priced in, or by the end of 2018, we had a 19.8% correction in the S&P 500. A lot of that is priced in. Banks are much more capitalized now than they were before the financial crisis. So we don't see a big event like the financial crisis where we could see more than, say, 30% downward from peak to trough on the S&P 500. Like I said, there's trade uncertainty, China uncertainty. Right now, the tariffs are very small in comparison to other economic forces. However, if they escalate, they can become a lot larger. And that's what people are worried about, and that's what's being priced in, is the possibility of that. And then in order to have a really bad recession, where stock prices get hit, harder than a lot harder than what we've seen so far, you've got to have cyclical sectors that are overheated, and we just don't see that. So in our estimation, at these price levels, there's a lot of opportunity versus more downside risk. That's where we see things right now. Here are the last 11 bear markets, 9 of which were in line with the recession, 2 of which were not. We have macro events that basically caused the last 11 bear markets. And when I look at these 3 main causes, I say, are we in a commodity spike right now? Well, oil has gone from $73 a barrel down to about $46 a barrel right now. And that's in about 3 months that's happened. So if anything, we have disinflation, not a commodity spike. Do we have an aggressive Fed? We just talked about the Fed. The Fed funds rate is at 2.38%. That is not an aggressive Fed. There are some distortions with the balance sheet being reduced, but even with the balance sheet being reduced, we don't see the current Fed in an aggressive stance. The market might be worried about that, but we don't believe that's going to come to fruition. And then extreme valuations. Earlier in 2018, we got up to about 19 times price to earnings valuations. That's high, but I wouldn't categorize that as extreme. And currently, after today's market, we're at about 14 times price to earnings, which we haven't seen since in about 6 to 8 years, depending on which market you're looking at. We've got valuation metrics which are as cheap as we've seen them in 6 to 8 years. So once again, we look at these price drops, not only in the U.S. but around the world as opportunities. 1, to get more cash to work. 2, to rebalance, which we've been rebalancing over the past 2 weeks. So many of you probably have seen trade confirmations coming in. And then if we look at the average decline in the stock market during one of these bear markets, the average is 30%. Well, we're at about, call it 16, 17% on the S&P 500. There's not, in our estimation, there's not a lot more downside risk at this point. And we just don't see the recession coming to fruition. It still could. Human psychology comes into play, and it could be a self-fulfilling prophecy, but when we look at the actual fundamentals, we really don't see it. Which brings me to my next slide. Have fundamentals changed? Not really. Autos ran at 17.4 million annualized in Q4. Capital goods expenditures were at a 9% increase pace for Q4. MasterCard data suggests 5% increase in holiday spending, the most in 6 years. To me, that doesn't scream that the consumer is worried about a recession and worried about their 401k accounts and investment accounts if they're spending more by 5% than they had the year before, which is the highest increase in 6 years. Job growth is still strong. We had an ADP report that came out this morning after the Apple news last night. and it actually really helped the market. It suggests 271,000 new jobs in December, which is the most that report has signaled since February of 2017. Wage growth is up 3.2% year over year. We get an employment report tomorrow, which will be very important. On Monday, we get an ISM non-manufacturing number. This morning, we got a slow ISM manufacturing number, which I'll touch on here in a little bit. Unemployment, 3.7, lowest since 1969. Earnings estimates have come down, but not much. We'll see after the Apple news last night. We'll see if analysts bring down their earnings estimates. That's definitely something we'll be looking at. The 10-year Treasury is now at 2.55%. Actually, we closed at 2.55, which is almost 75 basis points from earlier in October. And so one of the problems, the issues that the market saw was that interest rates were at 3.25%, which is not high in historical perspective, but the rate at which we got to 3.25, we got there pretty quick. We're at 2.5% now, 2.55%. So that's one of those risks that is now not really there because the market has driven long rates down. Mortgage rates are down about 0.5%. So all of these things that people were concerned about with increasing rates, well, we've just taken away 75 basis points in rates, which is just one less hurdle that we have for stock prices, which basically is the bond market telling us, hey, the bond market's pricing in a recession. So that's what I'm trying to get at, is there's a lot priced in here for negative news. This morning we got some numbers for December, I'm sorry, yesterday we got these numbers. Yesterday we got these numbers for December. I'm just going to go over a few of them because we definitely have seen some slower growth. If we look at the global number, 51.5 versus, just to give you some perspective, in August, that number was 52.6. Okay. Developed market, 52.3. In August, that was 53.8. Emerging markets, 50.3. In August, it was 50.8. So it's come down a little bit, but of the ones that we've talked about thus far, it's actually the one that's held up the most comparatively since August. US 53.8. In August, it was 54.7. So we've seen a little bit of a slowdown, but remember, anything over 50, which all of these major developed market, emerging markets, global, and the US, they're all over 50, which means we are growing just at a slower pace than we were growing back in August or even back in November. This morning, one of the things that spooked the market was that ISM manufacturing for the United States came in soft at 54.1. Once again, above 50, so it still means we're growing. It's just growing a lot less fast than we were. It's the slowest level of growth since November 2016. But like I said, still firmly over 50. Manufacturing is a smaller portion of the U.S.'s economy. On Monday, the ISM non-manufacturing number comes out, and that's going to be an important number. We'll definitely be taking a look at that. It comes out on Monday morning, so that's one that we're going to have data come out tomorrow for jobs, and then we're going to have non-manufacturing. Those are going to be market movers. Those are going to be things that the market's going to be looking at because the question is, are we headed for a recession or not? So every data point that comes out, the market's going to be looking and repricing things. That's what happens when you have a volatile market. We're not used to a volatile market because in most of 2016 and most of 2017, we didn't have a lot of volatility. Now it's picked up. Volatility in the stock market is normal. We typically see a peak to trough drop in the S&P of about 14% on an annual basis. In 2018, that peak to trough was just under 20%. So a little bit higher than 14, but not a whole lot more than 14. So earlier I talked about cyclical sectors and not really being overheated. So one of the things I wanted to point out is in the financial crisis, the thing that caused the financial crisis was an overheated housing market. Housing went from an average of 4.4% of GDP all the way up to almost 7%, so almost double that of GDP, and then it fell off of a cliff here. Well, now it's under 4 it's under 4% GDP. So we're not overheated in housing. If we look at auto sales used to be a real big part of GDP, a larger part than they are now, and they did cause some recessions in the 60s and 70s. But as you can see, they're a lot less important to the U.S. economy in more modern times. Business fixed investment, a little over 13% of GDP. That's a little high, but it's not to the levels we saw in 1999, and it's not to the levels we saw in the late 70s, early 80s either. It's pretty close to the long-term average. And then inventory is also right in line with where they've been as a percentage of GDP. So it's very hard for us to have a bust when we really haven't seen a boom. Now the stock market's up a bunch since the bottom, but if we look at valuations and we look at earnings, and then those valuation metrics based on those earnings, it doesn't tell us that we're significantly overpriced for where earnings are. So I put this chart here, and I went back to October 11th, and said, okay, what were the earnings expectations for 2019 for the S&P 500 on October 11th, 2018? Well, they were $178, and I'm going to just round to 50 cents. Okay. On December 20th, the latest data we have, they've dropped a little bit. Instead of 178.5, we're at 174.5. So call it $4 per share. Estimates have come down. That's only 2.25% that earnings estimates have come down. And you can see the earnings estimates in the red line here from the end, from October till now. They've come down a little bit. And 2020's earnings have come down a little bit, but not to the level that we would see a 20% correction in the S&P 500. Now, Apple came out last night, and gave a sales warning. They dropped their sales by about 8-ish% for Q1. For Q4 of 2018. And they're blaming it on China, and they're blaming it on the tariffs and the uncertainty, which definitely could play in. But it could also be that folks are keeping their iPhones a little bit longer, and the cycle's taking a little longer. So if it leads to more companies coming out that are saying the same thing, and earnings estimates going down, then that could lead to lower stock prices. But if it's more of Apple-only issue, then that's why Apple's gone down 40% in the last 3 months. And so there's prices and expectations, and those expectations are priced by the market daily. And that's we really want to make sure that we're in diversified, long-term type investments where we have a very good probability that we're going to earn positive returns over long periods of time. And we're not just looking at single companies. Profits in the last 4 quarters have been phenomenal. You would not look at this, the last quarter of 2017, 2017 up 17%. Q1 of 2018 up 27, Q2 of 2018 up 27, Q3 of 2018 up 32. You would not look at these this earnings per share growth and say, oh, this is going to lead us to a recession, an imminent recession. These are fantastic numbers. A lot of it has to do with the tax package. That's where we're going to get a lot of this margin. But we've still grown in Q3 of 2018. We grew revenues by 10%. That is not a sign of an economy that's imminently prepared for recession. So if we just got 6.9% earnings growth, which is what we got from 2001 to 2017, we just got the average in 2019. This market is significantly underpriced right now. Here is the daily chart of price to earnings multiples for large cap, mid cap, and small cap in the US. And you can see, depending on which one you're looking at, we got all the way down to levels we haven't seen in 6 to 8 years. This to me shows that if we are not in recession, if we're not heading to recession, stock prices are significantly undervalued at these levels. You're talking 2012, 2013 type levels. If you could go back, knowing what you know now, and invest in 2012 and 2013 at those same type of PE multiples, in hindsight, a lot of people would back up the truck and be very aggressive in those periods of time. That's very close to where we are right now. And a major reason for that is not necessarily that the markets have come down 20-ish%, but they've come down 20-ish% and earnings have gone up a significant amount in the last year to 2 years. Earnings are what drive stock prices over the long run. And when we look at valuation metrics, it doesn't always pan out that the valuation tells you, that the next 12 months you're going to have a positive return, but it gives you an idea of the next 5 to 10 years that you're going to have a better return, or at least history has shown that we would have better returns when valuation metrics are more attractive. So if we're looking at valuation metrics, this is just the S&P 500 for an example. Price to earnings multiple, after today, we're closer to 14 times. The 25-year average is 16. The Cape-Shiller, which I personally think is not a great metric because it's looking backwards and we've changed tax policy, and so there's a lot of distortion inside of that. Dividend yield, S&P stocks are yielding 2.3%. The 10-year Treasury is yielding 2.55%. Over the next 10 years, which one of those asset classes would I rather own? One that's going to give me 2.3% plus possible growth, or one that's going to give me 2.55% for 10 years if I locked it in? I'd rather get the dividend yield at 2.3 with the possible upside of capital gains from the S&P than locking my money into a 2.55% 10-year treasury. Price to book 2.7 versus 2.9. Price to cash flow in line. This bottom one is one that I really like to look at, which is the earnings yield spread, which is basically the PE flipped on upside down minus the basically the first junk bond, and you get 1.8%. So if we look at these in history, it's telling us that the domestic markets are pretty attractive, all else equal. If we take it a step further and we look at not only domestic, but we look at international is even more significantly underpriced, or we have a more attractive entry point with international. PE multiple of the All Country World Index ex-US, 11.5 versus the 20-year average of 14.2. The dividend yield is almost 4%. Where are we going to get a dividend yield of 3.8% and the upside, the potential upside of cap gains? That to me, that is a very attractive entry point. It's giving us a lot of cushion there. That even if we have some volatility in the downward direction, we're buying at a pretty dang good price. Just looking at more valuation metrics, U.S. and this is a 25-year range, 14. Like I said, it's closer to 14 now versus 16. Developed markets at 13.5 after today, they're probably closer to 13 versus 16. Europe, Japan, emerging markets, and then if we take a look at global earnings and we take a look at labor force and just where some of these other economies are in relation to the U.S., these other economies are a few years behind the U.S., and so I think there's a lot more opportunity, not only for valuations, is it a good time price-wise, but also I think there's more opportunity in earnings growth for some of these other countries. Why do we focus so much on the fundamentals and the valuation metrics? It's not to try and get a better return for next year, for 2019, because even though the S&P 500 is at 14 times multiple currently, it does not predict 1-year returns. A lower PE multiple does not necessarily predict. You've got returns all over the place depending on what your PE multiple is. However, if we say, okay, we're going to take that not just 2019, but we're going to go all the way to 2000. We're going to go the next 5 years to 2024. And what does that tell us about our returns from the S&P 500 through 2024? Well, it shows that the lower PE multiple is going to result in a higher return over the subsequent 5 years. If we don't have 5 years time horizon with our aggressive assets, we have the wrong time frame. We need to have at least 5 years with our aggressive assets, if not 10 years plus. So that's another reason why each client has a different portfolio and a different mix of aggressive assets versus safe assets, and we have different time frames. But if we're able to give it 5 years, we have a lot of confidence that we're going to get pretty good returns, given the fact of where we stand right now price-wise. This slide right here is just trying to show the difference between 2017 and 2018. I'm not so focused with the returns of each, although, on a side note, International performed better than domestic in 2017. Domestic performed better than international in 2018. But really, what I'm concerned, or what's important to me on this slide is what actually drove returns. In 2017, the biggest piece of almost every single one of these is this blue piece, earnings per share growth outlook. So we had earnings, and that's what drove stock prices in 2017. In 2018, once again, we have earnings, positive earnings, but that's not what drove stock prices. What drove stock prices were multiples, and multiples contracting, going from domestic early in the year, we had multiples of about 19 all the way down to 14. So it's that multiple contraction that gave us our negative return. Multiples contract mainly because of sentiment, because investors are not willing to pay as much as they were earlier in the year than they are at the end of the year, because tariffs and China and the Fed and all of these things that are now priced in. If we don't have a recession, these things are going to be repriced again. And it is our belief that stock prices are very attractive if we do avoid a recession, which is our base case scenario. I just put this in here. High yield spreads have blown out at the end of 2018. We don't have a big exposure to high yield. We have a little bit of exposure to high yield, but we haven't seen yield spreads this attractive since 2016, which just gives us a little bit more opportunity to move some of our bond portfolios to take advantage of a higher yield spread, a higher yield from some of these higher yielding bonds. Just another metric to look at to show that the market is pricing in a recession, or at least the potential for a recession. And then volatility, obviously, volatility has elevated. It's on par with some of these other events that have happened over the last 10-ish years, with about a 20% reduction in the S&P 500. Volatility is par for the course. In 2016 and 2017, we didn't see a lot of volatility in our equity portions, and stock prices went up 20-30% over that period of time. 2018, we saw a lot more volatility. More likely than not, when we're trying to get higher returns by putting some of our portfolio into aggressive assets, we're going to have to contend with this volatility. It's par for the course. It's something that we must endure to potentially earn higher returns. So where does this put us for 2018? Well, it doesn't happen very often. In fact, in the last 15 years, it's only happened once, and that was 2018. Cash was the highest performing asset class. In 2008, cash was the second highest. But then in 2009 and 2010, you can see cash and fixed income were completely reversed. It's not often that cash is the best performing asset class. It's not often that fixed income is the best performing asset class. And even fixed income was at zero. And if we looked at global fixed income, it was negative for the year, negative 1.2%. So there wasn't a lot of places to hide in 2018. And you can see an asset allocation portfolio that was diversified was down about 6%. However, even with that said, the last 15 years, we've still, in that asset allocation portfolio, we still earned 6.2% annualized. So it's not about 1 year. It's about the long run, and it's about taking these volatility spikes and using them to our advantage by giving us a rebalance opportunity, making sure that that we have enough liquidity in our cash accounts and our living expenses so that we don't necessarily have to sell at inopportune times. And we can give our aggressive asset classes longer to get these higher returns that they have gotten in the past, the longer that we've given them. So with that, well, investment implications, we still are very positive on small cap. In fact, more so now with valuations. If we avoid a recession, we believe small cap is going to bounce back probably the quickest. Developed international, emerging markets, I think you guys understand where we're coming from there. These are just more attractive. Over the next 10 years, these are the three areas that we expect higher returns from. Domestic equities, we haven't liked, and back in the summer of last year, we were really concerned about a few companies. In fact, about 10 S&P companies represented about 25% of the S&P, and that was concerning to us. And we took some of our domestic exposure and we put it into small cap and we put it into international. International has held up actually since then pretty well, especially as of late. Emerging markets has held up fairly well as of late relative to domestic. Large cap domestic has absolutely taken it on the chin in December. Unfortunately, small cap has also taken it on the chin because it's a more aggressive asset class, and when you're pricing in recessions, it's going to be impacted. And so that definitely happened in our portfolios. But we still have it. In fact, with our rebalancing, we've been adding to some of these positions, small cap, developed international. One of our funds, Oakmark, that's more value oriented, has kind of taken it on the chin, so we've been putting some more in there. Fixed income now at 2.55%. When we were at 3.25% on the 10-year, we were getting pretty close to the 3.5% we were hoping to get to on the 10-year, where we could actually do some things with our fixed income portfolio. Unfortunately, because of the price of recession risk has been filtered in, now we're at 2.55%. We're back to where retirees are not going to be earning very much in their fixed income portfolio. Better than they were a couple of years ago, but not as much as we were anticipating here in October of 2018. And then REITs and utilities have performed very well in this period of time where interest rates have come down a bit with fixed income. But going forward, we do see interest rates coming back up. If we avoid recession, like our base case scenario is, then those asset classes are not going to do as well, in our opinion, as some of these other ones. So with that, I do see that we have some questions. Rick is actually going to be asking some of these questions that we have in the queue.
Well, good evening, everybody. Special treat, you get me now instead of Nick. Yeah, we do actually. I think we have, it looks like 4 questions here as of now. So first question for you, Yassine, is our national, corporate, or personal spending and debt levels acceptable, and is this a cause for concern?
The consumer here. I'm gonna pull something up real quick. The consumer, we're not worried about at all, and I'll show you why in 1 second when I pull it up. There we go. Okay, so here's the consumer. We have $125 trillion in assets. We have $16 trillion in liabilities, most of which are mortgages. You can see that even though interest rates have come up a little bit, now they've come down. You can see net worth has come down a little bit. But to look at where we are in perspective of where we've been, the consumer is very, very strong. that MasterCard number, consumers are not afraid. They're spending 5% more in holiday sales than they did last year. So to answer the question, I'm not concerned about the consumer. Where I might be a little concerned is the federal government. We are running a $1 trillion deficit. You can see that if we look at the CBO forecast, it doesn't look pretty. We end up with 96.2% of federal net debt accumulated deficits in 2028. The reason that this doesn't concern me as much is because the federal government can always increase taxes. And that is why we believe that it is very important for each of our clients. Our clients are higher wealth, higher taxed individuals. I believe that our clients are going to have targets on their backs and are going to, a few things. One, Social Security and Medicare are going to be reduced, in my estimation, and taxes are going to be increased. So the things that we can do now to control those two things and take some income now while we have a very favorable tax situation by doing Roth conversions, those are types of things that I would do. So yes, it concerns me that we're on this trajectory here, but there are tools that we have at our disposal to correct for that, and that might be a reason why price to earnings multiples may not be 16 times looking forward, but are they 14? And then with interest rates at 2.5%, am I too concerned with having a debt load that's this high? There are arguments you can make on both sides, but one takeaway that I would get for everybody who's on this call is that I would expect Social Security and Medicare to have reduced benefits for the wealthy, and I would expect higher taxes on the wealthy down the road. That's how I would play that. I don't think it has as much impact on stocks as it does on taxes and Social Security and Medicare benefits for the wealthy. So hopefully that was a long-winded answer, but hopefully that answers part of that question.
Thank you, sir. Next question in the queue. Would you consider a one-year bank CD a safe or desired investment option in this environment?
1-year CD is absolutely a safe investment over the next year. However, I would point out that cash has only been the best performing sector 1 out of the last 15 years. So yes, it is a safe investment, and you'll earn right around probably 2% if you made the investment today. If you're going to use that money next year, absolutely, you should be looking at something, either a money market or a CD that's going to earn around 2% without taking any risk, or with taking very little risk. But if your time frame is 10 plus years, I believe that with markets priced the way they are, you're better off taking some risk with that money and buying at very attractive prices in our estimation than putting it into a CD. But if the question is, I'm going to use this money in a year, and is a CD safe? Yeah, absolutely. I believe an FDIC insured CD with a reputable bank that's earning right around 2% would be a good, safe investment. And
I'll just chime in real quick to add to that, to reiterate Sean's earlier point, if the time frame of the money needed is significant, like he's saying, within a year or two, again, that's something where reach out to myself if I'm your primary advisor or the other planners in the office to discuss that. And secondly, I would say that online bank accounts right now are yielding over 2% depending where you're going. So with a CD, you have that downside of the money being locked up, and if you try to pull it out, you have penalties to deal with. Whereas my online Barclays, for example, right now is paying me 2.05%. So, again, if you're looking at a CD comparable to what you can get with some online savings accounts, you may prefer to do that to have more accessibility to the liquidity. Okay, Sean, next question. It looks like we've got just 3 more here. If anyone else has questions, by the way, make sure you type them in while we're rattling these off. Sean, question, overall in general for the firm, what was the direction of the last rebalance that we've been working on?
So the rebalance, we did not change any of the targets. So all of the targets are the same. The last time we changed the targets was right around the end of June. So it was simply a rebalance where, because of the market movements since the end of June, we had basically less in aggressive assets than our targets, just simply because aggressive assets are down. If we go back to that Q4 slide, are down anywhere from 7% in emerging markets all the way to 19% in small cap. And then our bonds have held up. Our bonds are actually up for the year. And so it was simply, and I'm being very generic, but our targets didn't change. We just simply went back to where our targets were, which means we sold safe assets and purchased aggressive assets.
Okay, next question. How concerned are you with China, the trade war, and the continuing weakening of their economy and its effect on us in the U.S. markets?
Yeah, it's definitely a concern. I think it's more psychology than actual tariff related. It's very similar to the Great Recession when CEOs of companies started altering their plans because of what was happening. And so with the uncertainty that the government has created, that the administration has created, businesses both in China and the U.S., they have no idea what the rules are going to be. They have no idea what's going to come of these talks. I believe it's Ironwood's belief that the ultimate end game is some sort of deal, and China has been getting away with way too much for many, many years, and I think this is something that needed to happen. Right now, it's more psychological than it is actual tariffs causing the slowdown in growth, but it can escalate very quickly, and that is what is being priced in by the market. It's the potential for it to escalate quickly. So to answer your question, it's a concern. It's a valid concern. It's something that we're definitely monitoring, but we believe that the end game is that we have some sort of deal, some sort of deal that will take away uncertainty. And when that deal happens and uncertainty is removed, then businesses and business owners can start making decisions based on the rules that we know, and then growth will pick back up.
Okay, at the moment it looks like, I think we have one more here. It says, is it a bad idea to move into cash just until things stabilize a bit in the stock market? To answer the question quickly or succinctly, yes. We believe that if you're in a diversified portfolio and your portfolio is down somewhere
In 2018, you're down somewhere between 5 and call it 12%, depending on what portfolio you're in, maybe 14% on the more aggressive portfolios. We believe that if you wait until it feels more comfortable to be in the market, it means that prices are higher. If you're in a portfolio where you've gone down 12 or 13 or 14%, you're probably younger. You're probably adding to your portfolio. It's January 3rd, so your 401ks are all starting again. Your retirement plans are all starting again. It's counterintuitive for younger folks who are in the accumulation phase, who have more aggressive portfolios. Years like 2018, although when you look at your statements, you look at your net worth, you're like, wow, my net worth went down by X percentage points. In the long run, it is actually a very good thing. You're getting an opportunity to put more money to work. We had clients who were in the accumulation phase in 2007, 2008, 2009, 2010, 12. They were able to retire in 2016, 2017, 2018 because of the financial crisis, and they kept their job and they kept funding accounts at opportune times. And then fast forward a couple of years, the market does well, they have good returns. We pull back the risk in their portfolios because they're getting close to retirement. Yes, they've also taken it on the chin here in 2018, but a lot less than they would have in 2008, 2009 when they were in the accumulation phase. So it has everything to do. You should be in a portfolio that, one, is comfortable. If you're losing sleep over what your portfolio is doing, I absolutely encourage you, reach out to your primary advisor, reach out to me, reach out to anyone at Ironwood. We want to have conversations, because if you're in a portfolio where you're losing sleep, you're probably in an inappropriate portfolio, and we need to have those kind of conversations. So yes, I believe that it's a mistake to go to cash when, depending on the market you're looking at, aggressive assets are down anywhere from 10 to 25%, 30%. I think it would be a mistake if we went to cash only to reinvest 5 or 8 or 10% higher than we are now.
I think that's the last question. One quick update. One of our listeners pointed out that, and I checked online here, that Marcus Goldman Sachs online savings is paying 2.05%. And I actually checked Barclays. They've bumped it up to 2.2%. If you're looking for an online savings account, Bankrate.com is a decent website you can look at that can help you kind of filter through those. But if you're going to do that, please be careful. Read the fine print. Make sure they're FDIC insured. Make sure you know if there's minimums, etc. But just simply to reiterate that depending where you keep your cash, if you're in an online savings account, you might be able to get a reasonable yield right now. If there are any other questions, I'll give it maybe another minute if anyone else wants to add anything in here. Otherwise, seeing if we don't get anything coming in, I think that might be the last one. So let's just wait a little while longer, and then we'll wrap it up and we'll let everybody get on with their evenings.
All right, I think that's good, Rick. Thank you for everybody who attended tonight. It looks like we've had one of our most attended webinars here, which doesn't surprise me. We have better attendance when the markets are turbulent like they have been. Unfortunately, that's the nature of the beast. We will have our normal scheduled webinar the first Thursday of February. I don't have the date in front of me, but you will get information from us via email and invite, just like you did to this one. So look out for that. Hopefully the next time we talk, markets have stabilized a little bit, and we look forward to helping everyone through this. Thank you so much. Goodbye.